let's see. Alright, what you're seeing is just my ideas on a simple, fair, and flat tax. I have a blog, Dr. Timster, at blogspot.com. You're welcome to take a look. This is the simple, fair, and flat tax. Okay, and let me just explain how this thing works. Other plans and stuff, and I'd done this years ago, long before the 999 or any of that other stuff came out, and I made a quick little video, sent it to all the think tanks and people I thought would be interested. Never got a response. So anyways, this is it. Okay, this is regarding the income tax. There's two parts. There's the simple, fair, and flat. Usually when we think of, you know, the fair tax, they're just talking about a sales tax, a national sales tax, or the flat tax, which is just, you know, everybody pays the same rate of an income tax, but not referring to a sales tax. I think the best approach is to have both, and that it needs to be limited. I think what we need to do is actually go the full-blown constitutional amendment to make sure that just because we create a new national sales tax, that some wackos coming in later can't turn that into something, you know, horrible with, you know, keep raising the rates. So anyhow, let me just run through this with you. If you have any suggestions, meet me here. You can also reach me at Dr. Timster at gmail.com. Okay, so any critiques, criticisms, you know, not just, you know, you're a jerk or something like that. Just, you know, get some suggestions or something, or questions or whatever. Okay, the idea is, like right now, this is, you know, our employer, and the, you know, the responsibility of the employer is ridiculous, and we've turned it into such a negative to employ people, such an onerous burden on people, that you don't want to start a new business. So anyways, what we need to do is we need to just get back to where we were probably 100 or more years ago, where a boss or an employer hires somebody, comes to an agreement with that employee on what their work is worth, and pays them. Gives them exactly what they agreed to, and that's it. And so this boss, let's say we have this guy Joe, and let's say he has an income of $52,000 a year. So that's basically $1,000 a week. I think that's pretty good, pretty average for Americans. And I think this average needs to be taken into account, because what I want to do is there's some what they call a progressive tax code. The way we do it now is the more you make, the higher a percentage they take of your money, which I don't think is fair at all. But I think we do need to do a little something for people at the lower end. So let's say we have an average of, let's say, so $50,000 is the average, and I'm not talking about household income, I'm talking about per adult working, not counting retirees or minors, and what individuals. So an average. So let's say an average is $50,000. It may be something. It may be 40, but whatever. Just for an example, then you're going to pay the 10% maximum tax. If you're below that average, then we could take it all the way down. So if you're making less than $5,000 a year, you're not going to pay taxes when it comes to income tax. You will be paying sales tax, because everybody pays sales tax. And so anyhow, so this is all broken down into 8. So those of you who've worked with mortgages or anything like that, you know, those look for like pretty familiar numbers here. And it breaks down so that there's a proportionality. If you're below the average, and what this is supposed to do is kind of give people, you know, kind of some upward mobility, kind of help them along to get up. So they're paying the full amount of 10% tax. what I'd like to do is see to it that whenever we think of tax, we always think of 10%. I don't know if it's biblical or what, but it just makes sense to me. I like the concept of tithing. I think 10% makes sense. I think that if I was your agent, if you're an entertainer and I was your agent, I think 10% for lining up work for you makes sense. If you provide a service to somebody that they would, or opportunities that they wouldn't have, and one good way of being compensated for doing that is to get paid a commission, or maybe it's called a tax, or a portion of your gain. And I think 10% is fair. I don't think it's going to hurt anybody, and it provides compensation for a service that's rendered. And I think the government does provide a service. I think they create a market, they maintain a market, they protect the market. Anytime that you are able to, in this country, make a profit, it's because the government has made that available to you. If you, earn interest or capital gains or something, I think all taxes should be 10%. I think anytime that you have an increase, Uncle Sam should get a little taste of that. Not enough to hurt you, and certainly not enough to beat down your incentive for creating profit or gain or earning interest or anything like that. So anyways, and I know this looks like a big mess, but let me just walk through it with you. So the boss hires Joe. He pays him $1,000 a week. He gives him the entire check. The only thing that the IRS gets is a report from the boss saying, hey, I gave Joe $1,000 this week, or I gave him $4,000 this month, or whatever it is. But there's just a report that goes to the IRS. The IRS doesn't get any money from employers ever again. So the $1,000 goes to Joe. Now Joe, if he decided that, well, okay, I'm not going to do anything, I'm just going to spend all that money for myself, then he would get paid 10% of that $1,000, and he would then write out a check to the IRS for $100. But this is what I want to do. We have an IRA, which is an individual retirement account. We have a health savings account. We also have charity. So Joe can take that $1,000 and he could sit down at his kitchen table, write out a check for $100 to put into his IRA. Okay? If everybody does that, we don't need Social Security. He can take another check for $100, which is 10% of this, of what he got in, and put it into his health savings account. We do that. We don't need Obamacare. We don't need Medicare. We don't need Medicaid. Joe can also put $100 into charity. Now these have got to be legitimate, charities, 503c or whatever categories it is. They need to be legitimate, that where they're actually helping people. Americans help each other. And this pretty much takes care of any use for welfare. What we need to do is get this is federal. I'm not talking about anything state regarding here. This is federal tax, and we need to get the federal government out of charity. We need to get the federal government out of health care. We've got to get the government out of our retirement. And so that leaves Joe with $700 for the week. That's enough to live on for a week. And so instead of $52, that really gives him $36,400. If he kept this up every week for 52 weeks, he'd really have $36,400 to spend on living, housing and food and whatever else people spend their money on. And that, according to our little chart here, would get taxed instead of because this brings him below average. So he's at average, so if he didn't participate, he'd pay 10% to IRS. If he does participate at the level he's at, that drops him down below the $52,000 average. So he's going to pay 7.2% in income tax. So he just writes out a check for that week, $50.75 instead of the $100 he would have if he hadn't participated. Now, So there's 1,000 minus the 3, leaves him with 7. And so, and then if we look at this IRA, this is an individual retirement account. Different things he can do with it. He can use some of that to go into an indexed annuity life insurance type policy, or an annuity situation where, you know, that's paid for with you know, untaxed money. Same thing with unemployment. Each person should be able to have their own individual unemployment insurance that they pay a premium on. Same thing with disability. If we do these things, you know, this is your retirement money, and this is your unemployment, and this is your disability. That takes the welfare state out of the mix. And we're talking about competition between insurance companies here. These premiums are going to be pretty low. You've got all working Americans doing this, most likely. Same thing with the health savings account. You know, they call it kind of a bucket, you know, so you put money in there and you use that. And if people have to write out the check for their health care, you know, the hospitals and all the other healthcare providers are going to compete. They're going to bring those charges down. Same thing with like with catastrophic insurance. They, well, you know, some of this stuff happens. You know, you're forking out $100,000 with some of these cases. People needing heart transplants and things like that. So you should be able to buy catastrophic health insurance at a premium, and these rates will probably come way down from where they're at now. And then also like long-term care. So there's a lot of different things, a lot of different insurance products that are out there. And then when it comes to the charity thing, we're not talking about, you know, somebody just donating money to some church where this, you know, guy rides around in a limousine and lives the high life because he's a preacher and people give him money. No, these are legitimate charities where it's, you know, shown that they are actually providing care to those of us who aren't doing well financially. And also what I'd like to be able to do is, you know, once that money goes in, if you decide, well, I want to take some of that back out for my own personal use, well, you're going to have to pay 10% on it and get taxed. So both the retirement funds, your health care funds, this, the charity, once it's gone, it's gone. You can't get it back. But these, if you needed to tap into your money, you could, but you're going to pay the income tax on that. But I'd also like to see that, let's say I've pretty much maxed out my IRA. I mean, I've got all I need in there. I'm doing fine. I don't really need to put a whole lot more in, but I can still keep doing that. I should be able to use that and donate to people that I want to. It goes into their accounts untaxed, because it can only be used for that. And so this is all non-taxed. Now, at the point where this money at some point does get taxed, is, let's say, you know, like, you know, I've been paying a disability insurance and I get disabled. Well, now I've got money coming in and I've got to buy food and stuff. Well, that brings us to the national sales tax. And so that's where that money gets taxed, is when you go to spend it. When you know, if you're disabled, unemployed, or if you're retired and you're getting your money from that, you know, for the payout from that, then, you know, you're spending the money to live, and then at that point it gets taxed at the same 10%. And I think just 10% is what we need to focus on, is all taxes should be 10%. Okay. Now this is the national sales tax. This is the fair part of the simple fair and flat tax. This is a sales tax, 10%, and the way this works is it's collected at the city level, or, you know, local municipality level. You know, some states and counties, you know, they're set up differently. You got boroughs in New York, you got parishes in Louisiana, whatever. You've got a local municipality, you've got usually a county type structure, and the next step that would be a state, and then you got the federal government. So, if I went into a store and bought a widget for $100, 10% of that is $10. So the city is collecting the sales tax. They get to keep 3 of it for their own uses. They pass that money up to the county. They get to keep $2 of that for their own uses. They then take that money, pass it up to the state, and they keep 2. And then they take that money and send it into the IRS, whatever's left, and that would be $3. This tax is labor, food, and services. Nothing is exempt. This is an end user tax. It's not a VAT, not a value-added tax. So if you're, manufacturing something and you've got to buy raw materials, that's not where the taxes come from. This is the end user that pays these taxes. Okay, really simple. So let's say if a state says, well, the city says, well, $3 isn't good enough for us. They can add some more on if they want to, and keep it. Or the county says, well, that's just not enough. They could add a little more on, and the state can do that too. Especially, California's so wacky, they'll probably, really mess that up. The thing is when they come back to the federal government looking for handouts from the federal government, they're saying, hey, listen, you should have been able to make do on what you had, or if it's ridiculous, then, that would be a restraint on that. But the other thing is, we've got federalism. We've got, so if you want to live in California where they're going to add more than the $10 on the $100 purchase, and they're going to add 25 or something onto it, that's your right to stay there, but otherwise you could leave, If you don't like it, leave. After a while, and if you're a Californian, vote the jerks out that are doing this to you. It's just that simple. And so most states should be wise enough to just stick with that, make do with what they're collecting, because this is a huge influx of tax at the state level, and they're going to be dealing with all these issues, if need be, regarding people doing their retirement, unemployment, disability, health issues regarding at the state level, not federal. Federal government does not belong in these areas of our lives as Americans. Okay, next thing I want to talk to you about is just, like I said, all taxes should be 10%. I mean, they could go lower if they're not needed. Maybe we're collecting too much money. You can lower it, but you can never go above 10%. So, the corporate taxes. So you got your revenue, you minus the cost of of being in business, and what you got left is your profit. That's what gets taxed at 10%. I mean, it's pretty simple. That's all it should be. Companies, unless they want to, should not be involved in 401ks and all this kind of stuff. If they want to, if they want to have that type of arrangement with their employees, they're welcome to, but they don't have to. There's no federal or requirement for them to do that. If a state wants to require that, well, that's up to the state, and that's for the locals to vote on. But, this national stuff, we don't all get to vote on this national stuff. We got this representative government where things just get crammed through and things are imposed on us that we don't like Obamacare and all the other stuff that's been going on for the last 100 years that have been thrown in. The New Deal and the war on poverty and all this stuff has just added all this garbage onto it and is just keeping the Americans from succeeding as much as they should. So what we need to do is we can lower overhead because there's less government compliance on corporations and employers. We need to do tort reform, workers' compensation and liability. Those things need to be straightened out also because it's, this is just such a burden on business. And if you want to keep employers from putting their employees at risk through bad work environments or dangerous conditions, you deal with them on the civil level, and if they're irresponsible, put them out of business or fine them heavily for whatever it is that they're doing wrong. But to just force all this extra wasted money on all these regulations is just killing us. Same thing with capital gains. I heard some people say, well, you know, capital gains should be 0. That's dumb. Because, you know, the only reason you get a capital gain is because the government provided the market the conditions for you to have a capital gain. So they should get a little taste of it, 10%. So if your, you know, real estate appreciates, or your stock portfolio appreciates, or, you know, gains in value, you know, the environment was provided by Uncle Sam, and he should get his little taste of it, 10%. That's not going to hurt anybody, and that's not going to be a disincentive for anyone to invest. So that's the simple tax plan that I've got for you. If you have any questions, suggestions, criticisms, you're welcome to send them in to me. And you can get me at drtimster@gmail.com, or on my blog, drtimster blogspot.com.